So now, risk management, Alchemist risk management. Why did I call it that way? Because all of my risk management techniques are my foundation, things I've studied and I've like came up with from my previous, from my finance studies. Since I'm like, I know how to pick companies, I know how to value a company, and so I just like generated all of these ideas and theories and came up with my own theories too. So in risk management, we're going to talk about lot size, account size, and a stop loss. We don't want to trip with the lot size and account size. There's going to be a balance somehow, Three of them should be balanced: your stop loss, account size, lot size. It's like somebody is just going to the gym today and is going to lift like 100 kilos on biceps. That doesn't make sense. Then house money rules. I'm sure this is the first time you hear about this, unless you trade, bro, like you play poker. We're going to dive deep inside house money rules and how to manage your profits. Man, your profits are your edge. You gotta use these profits, man. Then Alchemist risk management methods, I do risk management in a different manner, So I start my month aggressive, then I take it easy, Then risk management scenarios, you gotta like think about risk management scenarios and see like when are you stopping your day, know your stopping point, because like for instance, if I'm getting in my car, I have a destination, because if I'm just going to have a ride, I'll end up like spending more money too, which is the same case in trading. You're going to overtrade and lose money. So let's get it.
First, we start with lot size and account size, stop loss. So in this case, the whole idea of this is for you to build a track record. Good. So it's more about consistency than more about doubling your account and having this kind of like phenomenal returns too. So for this, we have a really strict rules too. Let's say, for instance, let's say the average trading account is around 5 grand. This is the average trading account is around 5 grand. Good. So I have 22 days. I have what? I have 22 TD, trading days in the month. Good. So I want to be risking what? 1% risk per day. Perfect. So if I lose the entire 22 days, I'm going to end up losing what? 22%, which is impossible, if you just keep on putting up every day, risking what and controlling what you can control, risking the 1%, and you call it a day. It's impossible to just lose the entire 22 days. Dude. So our risk per day is 1%. This is my account, 5 grand. I have 22 trading days a month. Then now comes what? My stop loss, my lot size. So a stop loss in this case, in my case, it's kind of fixed. Not that fixed, but let's say it ranges between like 13 pips to 5 pips. It depends on the entry, depends on where I'm entering. Am I like entering an aggressive trade, like just buying a wick or buying that level directly after I have like previous confirmations, or I'm buying like a pullback, or I'm buying the continuation. It depends. Am I so confident in my trading skill too, or I'm just like, I want to give it like some kind of like width so it doesn't really get like stop me out. But for this, you gotta think about stop loss. So if you want to risk $100, so you shouldn't lose more than $100 too. So if you like have a 10 pips stop loss, and you see the trade is coming all the way down to your stop loss, you shouldn't like move it, because probably it's going to keep on moving down. So you just like accept the loss too. Don't increase it. Then we have the lot size. So let's say for the stop loss, it's around 12 pips a trade. So our stop loss is what? Is 12 pips a trade. So our lot size is what? Let's say 0.5 standard lot size. So then we have what? Then we have our first week, which we have what? 5 trading days in it. So here is the thing. We're building our track records, or we're trading for our living. So what we want to compound is, we want to compound our profit, not our capital too, because we're going to discuss it further in the next step or next session. So here I have my 1%, which is $50. So I'm risking $50 every day during my first week. So let's say for a fact, let's not just be so negative, and say like the first day you made like $200 return. This was your first day. Then second day you lost the 50 minus 50. Then the third day you made 100. Fourth day you lost the 50. Fifth day you made, let's say, 250. Which is really possible, trading gold with 0.5 stop loss. It's pretty simple to have this. So in total, you lost $100, right? Then you had 300, 400, 550. So you made $550 and you lost $100 equals how much? $450. So This was actually my first week. This was my first trading week. So now after that, I have my second trading week. Second trading week. So now I have my second trading week, and I finished or closed my week with 450 bucks. Now I have my capital, which is the 5 grand, and I have what? My profit, which is my house money. Then this house money, what is actually I'm going to be using for the next week or the second trading week in my month. Okay, house money rules. Good. What I mean by house money rules is the profit you make, how to manage the profit you make and take advantage of it. And instead of risking your capital, no, we risk what? Our house money, which is the profit. House money is the concept or like a terminology I took out of like poker. So now we're risking the house money. So now we have the second trading week. Now we have the second trading week. Okay, so we ended up from the first week with 450 bucks. Good. Let's say, for instance, we want to risk what? 50% or 70% of our profit during this week and distribute it equally over the trading days and like in this second trading week. Two. So we have 450 bucks. Let's say we want to risk 350 bucks. And we keep the 100 bucks as like a safe that, yeah, we got it, we withdraw it or we keep it. It's up to you. Like it's up to every individual. So I have 350. I have my 350 over 5, which is 70 bucks a day. So I have this 70 bucks, which is I want to risk every day. Okay, perfect. So I'm risking 70 bucks every day, right? And my average stop loss is 12 pips. So now my lot size is 0.6. 0.7, no, 0.6 here. So now my lot size is 0.6. Good. So I pull up the first day and I lose the entire $70. Just lost them. Second day, I lost the $70 too. Third day, I made $300. Fourth day, I made $400. Then, fifth day, I made zero. Didn't make anything. Was a break-even day. Didn't do anything. So, in total, I made $700 minus 140, which equals to 560. So I made $560 plus 350 minus 140, which is how much? Or no, we don't minus it. Is just the same, $910. So in 2 weeks, I ended up making $910. Me risking the same amount every day and doing the same thing every day, you know, while distributing my bets too. That's what I call the house money rules. That I keep on playing with the house money. I keep on playing with the house money. So now in total profit or house money profit equals to $910, which I'm gonna withdraw out of, let's say, $410, which is gonna equal what? $500. Then I have this $500 again to use for my third week, which is I'm going to have what? First day, second day, third day, fourth day, fifth day. Each day I'm gonna risk how much? $100. So each day I'm gonna risk $100. The same over and over again. Whatever I make, I take some withdrawals out of it. Take a portion out of the profit. Use it. While I'm already using my capital as what? as the margin required for me to open my lot sizes to. So here for 12 pips stop loss, average stop loss, we're going to use 0.9. 0.9 lot size. To 0.8 lot size. So I'm using already now, I'm using my capital as what? As margin, just so I can open my lot sizes. That's it. And I'm risking the profit I'm making. That's it for the house money rules. That's what I use on a daily basis in my life. That's how I start to trick my brain too, with over risking my lot sizes and stuff. So by now, when we reach the Alchemist risk management methods, we already talked about them. The way I manage my trades, the way I manage my risk, the way I use the house money, so on and so forth, right? But for this, you always need some kind of rules to what you do. So to talk about this, we're going to see it in the next chapter, which is risk management scenarios. So in risk management scenarios, we're going to discuss all of these odds, and what kind of scenarios are you going to be actually expecting? Perfect. So since we said something in psychology that since you're like in control of what you're doing and controlling what you can control, so we definitely can control the outcomes of our trades. Good. In some certain way too. Which we should always have 4 possibilities of our trading day. Which ultimately we're going even to execute 2 trades a day. That's it, 2 trades a day. That's all what you need. All what you need is 2 trades a day. That's all what you actually need. 2 trades a day. Good? So, in my first scenario, I have 2 winners. Then, I call it a day. Second scenario, I have 2 losses. I call it a day. Third scenario, I have 1 winner, 1 loser, and 1 break even, winner or loss. Fourth scenario is I have 1 winner, 1 loser. Good. So, in any circumstances, your trades should end up with small loss first. So, small loss, or second, small win, third, big win, or fourth, which is break even. You shouldn't allow yourself to have any other returns than this, or any other results than this here. So why is so? So we're starting from 2 trades a day. Good. Which will give us what? Scenarios. Then scenarios will have possibilities and outcomes based on the 2 trades a day, which we have 2 winners. In this case, once you have 2 winners, you call it a day. Why? After that, you will start overtrading, overthinking, and we discussed already the probability of you having right decisions after the first trade, second trade, third trade, fourth trade, fifth trade too. So we just want to keep it balanced too, and have the energy even and the vibration balanced, so the next day you can just pull up, do the same thing over and over again. Then in the case of 2 losses, we don't want you to revenge trade, which will cause more losses because you're not emotionally stable and you're not aware of whatever is happening in here at all. You see things in a different way too. So we don't want that to happen. So we just accept it. Acceptance, we come back to acceptance. Then in this case here, the first trade you made money, second trade you lost. So you should be, anyways, you should be in plus for this day. Then the third one, you either had a break-even winner or like a loss. You'll still end up with what? Winner day too. Like your day is positive. So after this trade here, which has 3 possibilities, is going to be some kind of overwhelming a little bit after having a first win. So the first win, your adrenaline, you know, is going to be higher. Your cortisol, your serotonin, whatever, all of these enzymes is going to be high after the first win. Your confidence is top too. So then you get your loss. Then you'll be like, yeah, I still have space to risk more too. So in case if you wanted to risk more to like another like 0.5% of your initial risk percentage per day, you take this trade, and whatever it ends up with, either a break even, a winner, or a loss, we call it a day, because we don't want it to affect that second day, like the next day, whatever, or like even the next trading week too. So, or you're going to stick either with a 1 loss, 1 winner, 1 loss. That's it, and you call it a day, because anyways you're going to end up with a plus day. If you start keeping like on taking more trades, your success rate when it comes to the right decisions is going to go down, like a bullish trend. So then we come to the outcomes. So it's either you have a small loss, or small win, or a big win, or a break even. You shouldn't allow yourself to have way more than this. Why? Because this is your success formula for in trading. Having a big loss, it's not your success formula. You know, letting your losses run more than your like winners, this is not success formula. You know, you will fail at some point. You can make money, but still at some point you're going to fail. So it's either you build that building right from the base, you know, or it's going to last for 1, 2, 3, 4 years, then it's going to fall down and kill a lot of people too. So that's it when it comes to risk management scenarios.